I think we've created an insurmountable problem. We can push this problem out for quite some time, but at the end of the day, what do they say? You have to pay the piper. I think all we're doing is delaying the problem, making it worse and worse and worse down the road. Eventually, we will run out of road.
We're talking 5 years here till, a lot of these come due. What is the roadmap that you guys see, and how will that affect the economy?
Our roadmap is a depression around 2030, not recession, not 2008, a significantly longer, significantly worse economic contraction because of these reasons. This is going to be the greatest wealth generating event that any of us will ever see.
Welcome, everybody, to the podcast. And today I've got Lauren Baker here, and she is an economist, and we're hitting the big items. Now, for everybody that's listening to this knows we talk a lot about economics, particularly macroeconomics, and in the last 5 years and things that has been a driving force and trend that we all see and hear, and it affects our daily lives. And a lot of people aren't even sure exactly why. So what the outlook is, what's happening now, and what does that mean for the coming 3 years, and how will that affect our assets, our investing, our businesses, and our day-to-day lives? Will egg prices just keep going up? And are we going to be able to buy homes? All of that is affected. So with that, Lauren, welcome. And I really appreciate you coming on. I have lots of questions, and I can't wait to hear from you.
Thank you so much for having me. I'm thrilled to get to talk to you about these items.
You have a very extensive educational background. A lot of people heard you had bigger pockets as well as others. So why don't you talk to us just a little bit about your background in economics? I always have to ask, why economics?
Why economics? That is really an interesting question for me because I did not start my career in economics. I actually started in fixed income research out of my undergrad, which I like to say I went from the dark side to the light side when I found economics after that here at ITR. And I absolutely love what I do. That was a realization for me that I didn't want to be doing that nitty gritty balance sheet analysis, really the bottom up. I wanted to be a generalist. I wanted to look at macro economies as a whole and tell that big picture story. So that gets me out of bed every day, get to go, like you said, to Bigger Pockets, BPCon this past fall, really tell the economic story, take those kind of academic numbers, those theories, if you will, and put it in context of what is the business cycle doing today? More importantly, what do businesses and individuals do with that information to outperform during any side of the cycle?
This is a big topic because really, I think a lot of people are seeing and feeling the change in the cycle.
Yes.
And we have been hearing things like news, indications, but when you're in these periods of economic changes, both short-term cycles and long-term cycles, there is a lot of confusion. And because we obviously don't know. It's really easy when everybody knows what's happening and see it moving, where interest rates are 3%, jobs are up, income's up, numbers are going, even in down cycles.
Exactly.
It's going down. This isn't going to change, right? But it's this weird in between where everybody's waiting. Is it going to go down? Is it going to go up? So where are we at just as a viewpoint in this overall cycle right now?
Sure. It's absolutely an inflection point. And you're right. Those are the most dangerous, but they're also loaded with the most opportunity because
yes, they are.
When everyone's moving in the same direction, when things are clear, well, you can't really outperform. But now is the time you can be that salmon swimming upstream. You can get ahead of the cycle. It won't feel comfortable because you will be, well, that one salmon swimming upstream. But I think where we are in early 2025 today in real time, this is the point at which the cycle is already showing the fundamental signals are turning up. So various different sectors move through the business cycle, not in perfect lockstep. But if I'm talking about the industrial economy overall, the manufacturing economy, GDP, those big picture items, they were a little bit cooler in 2024. It felt like, if not a down year, at least a flatter year, more subdued growth in something like GDP, even a mild contraction in the industrial and manufacturing economies. So headed into 2025, the good news is our fundamental leading indicators are showing pickup. They're showing signs of life, those green shoots already forming. So I expect this year to be better for most industries. Now, I say most industries because I know you have a lot of listeners today who are in some of those outliers. By that, I mean things like the residential construction market, that tends to move ahead of the cycle. So they're at a different phase, and non-residential construction moves behind the business cycle, which it sounds bad. I don't mean that in a judgmental judgmental sense, because it's kind of good to be moving behind the cycle. You have so much more forward-looking visibility. You can see all of these leading indicators with a year, even 2 years of really, really compelling leading evidence. You can absolutely know what's coming next for your business. Now, unfortunately, today, again, in early 2025, most non-res construction is in for a little bit of a cooler year this year. And residential construction, we can certainly talk there. I'm looking for a little bit more subdued growth in that sector.
Okay. And this has been an interesting theme because a lot of our listeners are even like me and my firm. I own product-based companies, SaaS businesses. The bulk of what I do is in commercial real estate. And a lot of people are dabbling in things. They either have a job, they're trying to invest. I own the stock market. I'm investing in Bitcoin, but I'm also a residential real estate investor, right? So this is an important point that you bring up, that in these cycles, different industries are at different levels. One's behind, one's forward. When you look at, let's say, for example, the residential, this lagging behind of the construction part, that can have a large effect on pricing and home prices, as we saw after 2008. So when we deal with home prices, what is your guys' outlook on that?
So home prices do tend to be a really good store of value. We don't see too many very significant downturns. I know we all lived through 2008, so that's fresh in all of our minds that it can happen. It does happen. I'm not saying it never happens, but this most recent cycle, we saw such a rapid run up in home prices. That is starting to ease off now. I've seen new home prices tick down a bit. Existing home sale prices still seem to have some levity to them. But that is factoring kind of in a circular way back into my forecast for new home starts, because with pricing so elevated and even more importantly, with interest rates, mortgage rates so high, that's casting some real affordability concerns over either a first-time home buyer's ability to go out and buy that house, or more importantly, on the mortgage rate front, if I'm an existing homeowner with a 3-4% mortgage, man, that is a hard decision to make, to sell that house, get a new mortgage at, 7% today? So we're seeing a real dampening effect of existing home sales. That in turn disincentivizes new home construction. And so I do think we need more houses. We've been underbuilding. Housing starts have not kept pace with household formations, but this affordability is kind of a wet blanket that I expect to continue weighing on new activity.
Now, is that affordability, in your viewpoint, more so a interest rate or a supply issue?
Definitely both, but right now mortgage rates are the, I'll call it the precipitating factor. So the rapid increase that we saw in the past couple of years in just how quickly mortgage rates ran up, that was the kind of shock. Home prices didn't respond quite that quickly. And like I said, we've been underbuilding, but that is a decade-long issue. It wasn't a shock to the system quite so much as interest rates had been.
I view the market as like this big organism that's moving, and all of these different things are working together and we don't even see it, right? Everything. But there's outside influences that act as, like, let's say, fuel, right? That's literally like food or oxygen to this organism. And interest rates are a major, major feeder to whether this organism grows, shrinks, dies, right? And so when you look at that interest rate, that can affect all these industries very differently, but it affects the economy as a whole in general. And I think a lot of people were very surprised that interest rates went up and the economy didn't stop.
No.
And too, inflation came down, but it didn't really, we're still feeling the effects of it. So with that, what are interest rates? What is the outlook of interest rates that you guys are predicting based upon the changes that we've already seen and the effect of it?
So interest rates specifically, if we look at Federal Reserve activity, right, what are they doing with the federal funds rate? We've already seen 100 basis points of cuts. So interest rates have come down. Now, going forward, we have been a little bit more cautious, saying, I don't think we're going to get quite so many more cuts to the federal funds rate as maybe the market had suggested just a few months ago. In the December meeting, the Federal Reserve came out and they actually decreased their outlook for how many more cuts. Now they're signaling about 50 more basis points of cuts. I think that's very reasonable. Again, maybe it's a little more, maybe it's a little less, but 25, 75, I think we're right in that range because we do see fundamental factors factors coming back for inflation going forward. I would love to give listeners the good news that we're out of the woods, right? Inflation is done and dusted. We're back. But it really isn't dead. There are very, like I said, long-term fundamental issues that will cause continued rise in prices. We can talk about very academic ones, right? The money supply. One thing that I'm watching right now is gross treasury issuance. There is so much liquidity out there that tends to be inflationary. But we're also seeing these underlying demand drivers, things like demand for more labor that's pushing wages higher. So that will keep a floor under inflation. If inflation does come back, I think especially in the second half of 2025, that's going to limit how many more cuts the Fed can do. So as we look for when will be the low point of this cycle, right? If I have to go borrow money, what's the right time to do it? Don't try to time the bottom. You don't want to play that game, I like to think. No. We're close enough to the low that if there's a reason for you to be borrowing to invest, that's probably going to make sense now, if it ever would make sense.
So how I've been viewing it and my underlying thought process, we had the same outlook when people were saying, oh, the Fed's going to cut interest rates. I did not believe, first of all, I believed they would, but if they did, it was not only going to be slow, but it was going to be basically non-impactful. They were going to do it and it would have very little effect on anything because the driving reason of lowering interest rates, right, as though we look at inflation, but it's the drivers of inflation that matter, specifically the money supply. And the fundamental problem that we had was that interest rates is contracting that money supply. But while the Fed is trying to contract the money supply, they actually have an enemy that is doing the opposite. And that was the government was spending 30% equivalent of the M2 money supply. So I looked at it and I went, we're basically replacing private sector money that's not flowing, but the government is making up for it with spending at a 30% of the money supply rate. And so it's taking out all the effect on the money supply of rising interest rates.
Yeah, and I think that's why you see something like mortgage rates today. They are not tracking the federal funds rate because the bond market, right, all of the supply demand balance that goes into setting mortgage rates, it's not just the Federal Reserve waving their magic wand. Those are driven off the long-term inflation outlook. And so as we see those factors come into force, yes, mortgage rates are ticking up again today, despite kind of where the Fed is headed.
The problem is that at the end of the day, shrinking the money supply, this idea of a soft landing, to me is non-cyclical. That is such a made up thing, as in you cannot shrink the money supply in an economy without having pain because somebody's losing the money. The money's going away and money going out of the system and not coming into it to replace it, right? That has an obviously disinflationary effect. Because demand is going down. Well, demand is going down because people can't buy things. So an industry, something's going to happen. And you either have debt losses or your jobless claims start to rise. Then aggregate demand goes down because people aren't getting paid. But none of those things were happening. And so the softer the landing, the longer you could say the high interest rate pain should theoretically be. Because it's just not changing anything with those factors, right? And when you look at the jobs market, I think the Fed thought that would actually rise. I think they thought, okay, unemployment's going to go up. It just never did. Is that something that you believe will change in the coming years? Right now it's wild. And I don't know how you can have such low unemployment and incomes rising and government spending and ever affect inflation. So do you think that's a part of it that we have to accept? That listen, this is probably just going to happen and not necessarily, it's a bad thing, but do you want inflation for 100% of the people or do you want unemployment to rise by 3%?
I think there are enough kind of outside factors this time around that some of the traditional, I don't want to say rules, but norms of the economic cycle, they're just not behaving as they had. So the Federal Reserve, as you said, they target two sides of their dual mandate. It's inflation on the one hand and it's full employment on the other. So they're looking at inflation, they're balancing that with the unemployment rate, job losses, job creation, et cetera. But at the end of the day, we have other very fundamental factors that are driving our labor force balance, or I'll say today, lack thereof. We still have less than one unemployed worker for every available job opening out there. That is not for anything the Fed has done.
Yeah.
That's because we're getting a lot of foreign direct investment, a lot of re-onshoring, reshoring, those are longer term trends. But the real one that I'm looking at is demographics. We just don't have a ton of new entrants to our workforce.
Yes.
In fact, Gen Z, they're the ones, just leaving school now, starting to get those first jobs, enter the labor market. They're a smaller generation than the millennials, my generation had been, and they are certainly not of sufficient size to replace all of our retiring baby boomers. So when the Fed is up against a demographic problem like that, they can't create more workers, right? We can encourage businesses to be more efficient with their existing workforce. That's maybe one way around this, but there's no time machine we can go back and have more babies 20 years ago to make more workers now. We could do things like immigration in the current administration. I don't really see that adding to our labor force at the moment. So I think when we add the labor market discussion into this, that tightness, that is long term. That is really here to stay.
Yeah, this is an interesting issue because it's not a short term. There's nothing you can do to fix that short term. I mean, even if everybody had babies, they're not working age. So it's not, that's not something that happens. And immigration too, we saw immigration at levels unlike anything we've ever seen. And that didn't affect it. And so I agree. And I think the answer to that probably will be productivity.
Yes.
And I think that's a big change. Like when you look at AI and the productivity that it generates, it does remind me a lot of the early days of the internet and the fruits of the internet that we saw, not late stage internet. Late stage internet was just consolidation of wealth, but early stage was actually really good for efficiency and productivity. Like productivity really rose because of that. And I think that has a huge play in how the labor force and everything's acting, where we can actually do more and people are shifting towards that because the workers aren't there. So it's a self-perpetuating need.
Yes.
Do you believe that is going to help with productivity and will be a driver of growth that we frankly probably haven't really had since 2004?
I would go back even further. I would say the 90s. That's when we really saw labor force productivity just take off, as you said, in the early days of the internet. Yep. Now, I couldn't agree more. We need this to happen from a labor productivity stand. It is fascinating to me. I was looking at some specifically manufacturing labor force productivity numbers. Those are actually backtracking. We are losing productivity efficiency on the manufacturing side, which to me is just wild because that seems like the easiest gain, where I can have some automation or robotics, co-working robots, right? Something to make my human workers more effective. We aren't yet seeing AI really be put into place in a way that is contributing to productivity. I think certain companies are getting it right, but we aren't seeing it wide, kind of broadly across the sector.
It hasn't been adapted.
It hasn't been. And so many of the clients that I talk to, I mean, they're hearing these AI strategy is nothing more than throw money at the problem, let someone try to figure out a solution, but they don't have a really targeted strategy for what problem do I need to be solved? How will I use AI to solve it? They're kind of still about the buzzwords. So I'm waiting with bated breath to see this productivity take off. I really, truly believe it can happen. And to your point that it needs to happen, because with limited labor availability, well, what is that doing? It's pushing up wages. So if you're not getting more out of these workers that you're paying more for, that's just a continued margin squeeze for most businesses.
Yes. And this becomes another problem. You can't hire as many people.
Exactly. There's just unavailable.
It's crushing businesses.
It is.
And it is. The labor squeeze the last 5 years has been mind-blowing. Like what it's done to businesses and everything else, and having to redecide how our businesses operate because the cost of labor, it's so dramatically changed since 2018 that it no longer even makes sense in a lot of cases. Where once again, I'm not advocating that people make less, but I'm advocating that there is an actual thing where if I pay a certain amount, I literally can't make money. I'm negative. So the product can't exist. So it is a problem. And that low unemployment rate driving it, right? I agree. I don't think there's a quick fix. That effect on inflation, is big. One of the ideas that I've actually been talking to a lot of people is this idea that interest rates will go back down to 3%. I think people forget that's kind of an anomaly, meaning in the history of the United States, those low of interest rates were a 10-year thing from the Great Recession that happened that's never happened before, ever. when we did our first like portfolio acquisition and we had like 5.5% interest rate, we locked it in for a decade with prepayment penalties because there was no way we would ever see interest rates under 5%. It was mind blowing.
Absolutely.
3 years later, we were at like 3%, or whatever it was.
Yes.
But the point being is we couldn't even imagine it at that time. So this expectation that interest rates will go back down, I don't even know that will happen.
I completely agree with you. I mentioned before, I'm a millennial. So being the millennial economist, all my friends come to me and they say, hey, when am I going to get to lock in my mortgage rate at 3%? And today I say, unless, again, you have that time machine and you can go back to 2019 to do it, I don't see this happening in the rest of our, I don't want to say lifetime, but at least the remainder of this decade, let's say. It's not going to be just a bounce back down. So not to say it could never happen again, because it did happen once, but this is not normal. It just happens to be more fresh in all of our memories, and human nature is such that we normalize the thing that we saw for, well, it was a very long time. That was a very long bottom of the cycle post-Great Recession, post-2008.
Now, the biggest argument, the only one that I've ever seen that people come back with at that is that it literally has to, because the government can't fund at the level of interest rates that we're at today. And so this has been the one argument that everybody says, actually, no, it will, and it has to go back down. So we're waiting for it, because if not, the government can't pay. So they're going to actually make interest rates go down, which I'm like, that's not how that works.
Exactly.
But that argument, though, is that a true thing? Is that there, like, will they go bankrupt at this? Like, how do we look at the government part of interest rates at this level? And are they just going to put interest rates down so they can afford more debt, or they can refinance into better interest rates? Is that a real thing?
So under the current structure, like you said, the way the world works today, the government, meaning like the executive branch, right? They do not have the power to influence interest rates. The Fed is a nonpartisan, right? They're not a political body. Now, I do worry about the government's ability to fund itself just because we have been living beyond our means for so long. I think we've created an insurmountable problem. We can push this problem out for quite some time, but at the end of the day, what do they say? You have to pay the piper. I think all we're doing is delaying the problem, making it worse and worse and worse down the road. Eventually, we will run out of road. At ITR, our expectation is that the end of that road, so to speak, comes right around 2030, and not for government spending issues, but really the other side, the funding side of that, which is our demographic pinch point. So when the baby boomer generation kind of reaches that critical mass, that glut, that our entitlement spending, Social Security, Medicare, Medicaid, those are just not possible to keep rolling over as we have been doing it. So I see your point that maybe it is ultra low interest rates, but I don't think that's just going to be this painless, we cut interest rates because of the economic cycle, because of all of these other fundamental factors. I see 2030 more as the bottom falling out. Maybe we don't roll over a treasury auction. Maybe if a treasury auction failed, right, that would very likely have interest rate implications, but it would not be the pain-free kind of mechanism that we would expect in an interest rate adjustment. There would be very, very real economic fallout.
Yeah, too, if you lower interest rates, but then we have 30% inflation,
right?
You didn't help yourself. The government didn't make it more affordable. So it's one of those things that I get this idea that, the government has to do this to pay it, but that doesn't mean that they can pay it if they do it. So just because there's not a good alternative solution doesn't mean they can do that
exactly
without ending it. And I think this is where it gets complicated for people, because they go, what then is the outlook? I mean, if we're talking 5 years here till, a lot of these come due, what is the roadmap that you guys see, and how will that affect the economy?
Our roadmap is a depression around 2030, not recession, not 2008, a significantly longer, significantly worse economic contraction because of these reasons. If our government, the gold standard, right, the full faith and credit of the United States government, that is the risk-free rate as we call it, if they can't fund themselves on a continuing basis, that will have just massive global implications. So something will give, right? There will be a way out of it, but at that time, I really do see this as that's the bottom falling out from everything. And so we are looking at the end of this decade for a massive economic event. Again, I think demographics are going to be the precipitating factor. I'm not sure what will be exactly that straw that breaks the camel's back. Maybe it's a failed treasury auction. Maybe it's something else. I don't know exactly. I call it the Lehman moment in the context of 2008,
Yes.
right? What is the Lehman Brothers? No one could have pointed to that exact thing. But man, those forces are mounting. Those pressures are not going away through anything that anyone in Washington is doing, through anything the private sector even would have the scale to do. So
I completely agree. I look at it and I say this will probably be the depression or the major contraction that is government driven.
yes.
And I think people need to realize that in 2008, what we did is we moved risk from private to public. That's all we did. And since 2008, we've only been moving risk from private to public. And so the public risk doesn't go away just because you're getting paid a lot and housing prices are going up. So like, when you look at long-term debt cycles, I think there was this idea, and I thought it was in 2008, that this was the end of the long-term debt cycle. Like we were going to contract and erase all of it, and we were going to do it, and it's going to start over. And what happened is we just moved it. That mounting debt from the 60s and 70s when we went off the gold standard to 2008, it didn't go away. It got transferred. So we still have it. And then what we did is low interest rates, we all took out more debt. And so I agree. And there's been this big idea, and I've been waiting to say, when is it going to come time to address it? Which I think there was more of a social move to address it that we've seen in things where people are like, this is out of control. And we're seeing it in interest rates. Now, there's been an idea that this presidency is going to use some people and things to attack this spending and this debt problem, everything else. Is this some kind of viable solution? How do you think are they going to be able to tackle this? Or is it like, listen, this is just going to have to happen?
I think at this point, the problem is so huge. I don't think any administration now really could tackle it. And we've seen increasing deficit spending, increasing debt. I mean, really, the Clinton administration was the last balanced budget that we saw. So this is not a political issue. It's red and blue. Both sides have been contributing to the problem. Going forward, maybe we'll get some savings, right? I know that's a policy that the incoming administration is putting into place. But on the other hand, they're also talking about a lot of tax cuts, and that tends to increase the deficit, all else equal. It would be very hard for the kind of tax policy to fully make up that amount of income. And again, we don't have official proposals yet. A lot of this might just be campaign rhetoric. It might be left on the campaign trail. But for those that are brought forward, it does punch more holes in what is an already very big deficit. Now, all of that said, we're here in 2025 looking at, 5 or so more years before this problem really comes to a head. The scale of the problem is such that it would just be so hard to pivot at this point. The degree, right, the magnitude to which we would have to do something, it's just mounted. I mean, there's more than $100,000 of debt per capita, public debt. So that's every man, woman, and child has $100,000 of U.S. government debt on their heads. That is not something you can overcome through a little bit of cutting.
And then private debt. It's a twofold issue. I mean, for anybody to understand the situation, 2018 to today, we took on as much debt as we did from the first 125 years of our country in just those years. So can we outgrow it? Can our economy pick up, and can we actually outgrow this problem? Is that a viable solution to where our GDP will rise, private industry will take on, and our taxable accounts will grow, and then our GDP to debt will lower? Is that a viable actual outcome?
I'm not saying it's impossible, but that would be kind of hockey stick growth required almost immediately to outpace it. Where I really see that factor coming into play is after 2030. So not through the downturn, it won't avoid the pain, but I see that getting us back out of this depression. So sometimes when we talk about a depression, that seems like the wall at the end of the road, right? That we crash into, there's no life after. There clearly will be life after this. So something has to get us back out of it. And I think that is the longer term solution here. Now, that's why I can sit here as an economist with a goofy grin on my face talking about a depression. I look somewhat manic, But I see this as a huge opportunity for anyone who's willing to be a little bit more conservative headed in, right? Protect what you have through the downside. Be ready to invest at the low point, buy up anything you possibly can. This is going to be the greatest wealth generating event that any of us will ever see.
Yeah.
So if you're willing to, like I said, be that salmon swimming upstream, weather the downturn in a somewhat more protected way, yes, there will be new industries, new companies forming. If you can get in at that low point, just man, it's going to be a lot of fun on the upside.
I agree. And I do think that the contraction that will take place, I think there's one thing that we always look at, and people go too nihilistic and they go way too opportunistic, because what you do is you have problems, but you also have solutions.
Right.
So the solutions, though, we can't see. So a lot of the problems, they are more self-evident. Like we know that we can't find a lot of the solutions. There is, though, the opposite, that the optimist, right, that is just purely optimistic, that they don't realize. But the problems don't go away. Yes, there's solutions, but solutions do not mean no pain. And that is something I think we've really forgotten in the United States. We expect solutions, and we do not expect pain to come along with it. We expect the economy to shut down, and I expect to not only get paid, I expect to get paid more. So with the economy not even working and not even saving, and it's so I think that whole mentality that we lost after 3 generations of not seeing a depression or anything else like that will have to end, and it will be a social shift. What we're seeing is the symptoms of a larger problem that will express itself, and people will come back down to earth, and the United States will return to first principles. Whereas I think a lot of it, we just don't have pain. The government solves everything, and the private sector they're bailed out for everything. And it's nice, but it can't go on. And a printing press, I think, could you explain that real quick? Everybody thinks you can just print. I hear that all the time. We can just print money.
We can.
How does that work?
We could if we really wanted to, but yes, we've seen, actually, there is historical precedent. So many of these things are just theoretical, but we have seen in other countries what happens when you print money. That means there is more money out there. That means, well, we haven't shifted the fundamental amount of goods, right, you can buy. Maybe we'll have a little bit more production happening, but when there is more money, supply, demand, they rebalance, they reset prices much higher. That is what inflation means. We can see, again, these historical cases for hyperinflation. We can see, look at Argentina today. Their inflation rate is north of 200% and still climbing.
And that's the downside of printing money, right?
Exactly. The money's just worth less when you print more of it.
So it's not that we can just print our way out of it. So our nominal debt, because theoretically it makes sense. You have $25 billion in debt. Well, what if I just printed 100 or 25? What's this number?
The numbers are mind-boggling, right?
Mind-boggling. Nobody can understand them. Yes. Nobody understands what $25 trillion is. Nobody does.
Meaningless.
It's meaningless.
But we could, to your point, we could print that money and we could pay off that debt with meaningless dollars that are worth less than the paper they're written on at that point. But that doesn't mean there won't be pain somewhere else. In this case, it's inflation. Now, there are other solutions out there. It's not just printing our way out. We could just default on the debt. That's one I hear very commonly. Throw our hands in the air, say, we're not paying it back. China bought all our debt anyway. That's the narrative everyone likes to tell. It turns out not to be true. More than half of our debt is owned here in the United States. We're not sticking it to China. We would be hitting our own pension funds. We would be hitting a lot of institutional accounts, money market funds. That's the kind of thing that you just can't default on. A money market fund, that's $1 in, $1 out. This would fundamentally break the system. So sure, we could do it, right? There's a legal mechanism. We could push it through, but that wouldn't be pain-free either. To your point, there will be pain one way or another.
And I actually believe that the defaulting of debt on American citizens is what will happen.
Really?
So, yes, because I believe they'll do it before other countries simply to avoid a war and a lack of confidence in buying the dollar. So other people and countries will say, we'll buy the dollar because you guys will just screw yourself. And, we don't want to mess with defaulting on other countries and then having bombs thrown at us. But because at some point you wonder, somebody has to not get paid. Somebody. How else do you do it? So debt has to, because the money supply has to go down and debt has to go away. The reconstruction of debt, does it come from borrowers? Does it come from the government? Does it come from the private sector? It'll probably be a mix of all. And then it will come down to who gets hit the worst or the hardest. But I think, once again, just looking at history, everything else, we do have a huge army. So I guess if we defaulted on other countries, it'd be like, yeah, try that. But right now we have another problem that, we could go on about this, but this is the last, and I think really important factor is what we do here. Other people are moving capital here because their situation's not good. So a lot of people are like, oh yeah, well, America will go down and I'll just move to another country. And I'm like, you act like those other countries are independent of us first, or that it's better. Find me one country that's economic system is better than ours, that is not tied to ours, that can even at a large scale, sure, some island somewhere that's only fishermen, but an actual large economy. And so that's not really a viable solution, is it?
I don't think so. And if I can bring it back to the near term, I mean, there's so much reason to do business here in the United States. We are seeing just huge foreign direct investment, huge re-onshoring flows. Those are fundamentally driven. I mean, there's a very valid reason the dollar is as strong as it is today. So while we have some very fundamental issues from our terms of our government spending, from our demographics, other countries also have these problems. They also have some different problems. Our demographics, again, that's what I'm really pinning this timing on, is the demographic profile of our country. Demographics are much worse elsewhere in the world. Europe is older than us on average. Even parts of South America.
We had millennials, you and me. I 84.
Okay, you made the cut.
There we go. I made it just barely, but I made it. But like, you're right. This millennial, people don't realize how important and unique it is.
Yes.
Other countries didn't have this ginormous millennial. We're the only ones.
We certainly lead the way. Yes, absolutely.
China, Russia.
China's population is declining now. I really think it should have gotten so much more attention when India surpassed China as the most populous nation.
Yeah.
That is huge. Demographics, in a way, really are destiny for countries. And so to see China's population aging, starting to decline. Japan, they have the ultimate demographic crisis. Today in Japan, they sell more adult diapers than they sell baby diapers. That is not a good demographic balance.
No. So, all right. Bringing it back to the short term, so I don't keep you all day. You've been generous with your time. Your outlook over the next 3 years. You're seeing good things happen. You're seeing roots, right? These longer systemic problems we'll see as these things play out. Of course, there's other factors, all that. So take us into a next 3-year outlook. Do you guys see inflation coming down? Do you see robust growth? And where are your areas that you're advising people to say, we like these areas? These areas are benefiting or they will benefit.
I do see general growth in the next 3 years. I think growth will pick up a bit in 2025. It will grow a little faster, a little slower. It's going to be more muted than that immediate post-pandemic bounce back. Those were some very elevated growth rates. So I don't want anyone to reset their expectations to, say, 2021, 22 timeframe. That was too high. We had stimulus kind of giving us the shot in the arm. But steady growth, maybe that means more manageable growth for a lot of folks who just couldn't keep up in that post-pandemic era. We are now into just a pretty healthy economy. I think inflation, though, is going to be a longer term concern. I mentioned probably by the back half of 25 starting to pick back up, more pressures in 2026. Where we sit today, we actually have pretty muted inflation on the goods side of things. Commodity prices have either come down or they're trending relatively sideways. There's a risk, especially with something like tariffs, that goods inflation does start to heat back up again. But today and going forward, I think the real driver is going to be the service side of inflation. That's where, as I mentioned, tight labor market, keeping wages higher, that trend isn't going anywhere. So if you're a business looking to hire, I would say do that as soon as possible. Lock in those labor costs when you can. But otherwise, watch that margin squeeze from the kind of continued inflation grind. I think we will have relatively higher inflation in the next 5 years than we had in, I'll call it that post 2008, but pre-COVID. We think of that as the last normal decade or a decade plus. Inflation was historically low during that time. So I wouldn't be resetting expectations and using that same playbook. But for the rest of, the next 3 to 5 years, good, steady, healthy growth. We're not lighting the world on fire, but we're not seeing the bottom fall out either. The consumer is very strong, driven by that healthy labor market. So I really do see a good, stable foundation.
Do you see outside the United States continued wars, issues? Do you think those will not only continue, do you think they will grow, or do you think this is a phase we've kind of moved out beyond and they'll start to pullback?
So it seems like at the moment we're in I hate to call it status quo, but where there is geopolitical conflict, it's more a long grind. It's not an active flashpoint. There's always the risk that some black swan event strikes from a geopolitical stance, right? I'm not a political analyst. I wouldn't want to guess what's going to heat up where, but I will say those pressures are thus far largely outside the United States. I see the real risk of something like that being more in pricing that could cause some pop in commodity prices, right? Throw a little risk premium onto this pricing. I don't see it as being a fundamental kind of production hit or say GDP hit to us.
Yep.
If anything, it might even give a little boost to the defense sector.
Awesome. I am so grateful. I've been looking forward to this podcast. It's been great to talk to you. Where can people go to learn more about you, learn from you, or get a hold of you?
Sure. We have a lot of resources on our website, itreconomics.com. You can also find us on YouTube. We have a lot of shows. You can see my show, By the Numbers, which is something I'm so excited about. We cut through headline noise and we bring numbers to the emotional facts. We have something called Fed Watch, watching the Federal Reserve. That comes out every Friday. And so I would say stick with Fed Watch as long as interest rate policy is up in the air. Trends Talk is another show we put out weekly. A lot of blog posts, other resources there. You can find a little something for everyone. Again, it's itreconomics.com.
And we'll have that in the show notes. Thanks again for coming on and taking some of your valuable time. Really appreciate it and can't wait to learn more and hear more from you.
It's been a pleasure. Thanks for the great conversation.